Hey everyone, and welcome back to the channel. Have you ever found yourself saying, hey, I can afford the monthly payment? It's a super common thought. Whether you're eyeing a brand new car, the latest smartphone, or even dreaming about your first home, that low monthly number looks so manageable, so tempting. But focusing only on that payment can be one of the biggest financial traps out there. Today, we're pulling back the curtain on the hidden costs of the I can afford it mindset and how it can secretly drain your wallet over time. Let's start with a classic example. Buying a car. You walk into a dealership and the salesperson asks, "What kind of monthly payment are you looking for?" You say, maybe $400. And magically, they find you a shiny new SUV that fits right into that budget. You drive off the lot feeling like a winner. But what just happened to get you to that $400 payment? They might have stretched your loan term from 5 years to 7 or even 8 years. Let's do the math. A $30,000 car loan at a 6% interest rate for 5 years means your monthly payment is about $580. Total interest paid, around $4,800. Now, let's stretch that to 7 years to get the payment down. Your new payment is about $439. Seems better, right? But hold on. Over the life of the loan, you'll end up paying nearly $7,000 in interest. That's over $2,000 more just to have a lower monthly payment. You didn't save money, you just paid more over a longer period. And by the time you finally own the car, it's 8 years old and has likely lost a massive chunk of its value. This same trap applies to so many other things. Think about those by now. Pay later services for a new laptop or a fancy couch. 0% interest for 24 months sounds fantastic. But what happens if you miss a single payment or don't pay it off in time? Often, the company will retroactively charge you all the interest you would have paid from day one, and at a very high rate. Suddenly, that great deal becomes a mountain of debt. It's a business model that counts on you slipping up. And then there's the big one, buying a house. A mortgage broker might show you a 30-year loan with a payment that seems doable. But did they break down how much of that payment is going toward interest versus the actual principal of your home? In the early years of a 30-year mortgage, the vast majority of your payment is just feeding the bank. You're building equity at a snail's pace. A 15-year mortgage, on the other hand, has a higher monthly payment, but you build equity much faster and save a staggering amount in interest. We're talking tens or even hundreds of thousands of dollars over the life of the loan. So, how do we break free from this monthly payment trap? The first step is a mindset shift. Instead of asking, "Can I afford the monthly payment?" start asking, "What is the total cost of this item?" Always look at the total price, including all the interest you'll pay over the entire loan term. This is the true cost of your purchase. Second, always try to save up for a larger down payment. The more you put down up front, the less you have to borrow. A smaller loan means less interest paid, a shorter loan term, and a lower monthly payment without any tricks. It puts you in the driver's seat of the negotiation, not the lender. Third, explore shorter loan terms whenever possible. Yes, the monthly payment on a 15-year mortgage is higher than on a 30-year one, but the long-term savings are immense. Run the numbers using an online loan calculator. You might be surprised at what you can actually afford when you see how much money you'll save in the long run. The same goes for car loans. Aim for 5 years or less. If the payment is too high, it might be a sign that the car is simply out of your price range. Finally, let's talk about opportunity cost. Every extra dollar you spend on interest is a dollar you can't invest, save for retirement, or use for a vacation. That $2,000 extra you paid in car interest could have been put into an investment account. Over those 7 years, it could have grown into something much more valuable. Focusing on the total cost isn't just about saving money. It's about freeing up your money to work for you, not for the bank. The I can afford the monthly payment mindset is designed to make you feel comfortable spending more than you should. Lenders and salespeople use it because it works. But now you know the secret. By focusing on the total cost, making larger down payments, and choosing shorter loan terms, you can take back control of your finances. You build wealth faster and avoid the hidden traps that keep so many people stuck in a cycle of debt. Thank you so much for watching. I hope this helps you look at your next big purchase a little differently. If you found this video helpful, please hit that like button and subscribe for more tips on how to manage your money wisely. Let me know in the comments if you've ever fallen into the monthly payment trap. See you in the next video.